My name is Mark LaMonica. I look after the individual investor team for Morningstar here in Australia. And today we're going to talk about inflation. I'm not going to make any predictions on where inflation is going, but we'll look at the current situation and we'll look at some of the investment implications if inflation actually does take off. But first, we have our housekeeping items. So anything you hear today is general in nature. I don't know anything about you, so I can't offer personal advice. But I would love questions. So send through any questions you have about inflation or, anything else. Yeah, we can go from there. All right, so let me get into the deck. So I hope people in Sydney have enjoyed their first time weekend of freedom. It almost killed me, my wallet and my liver, but that's okay. It's good to be out. All right, inflation. So let's go back and let's look at history and let's look at what's been going on with inflation. So as you can see from this chart, we've got two different things on this chart. So we've got the consumer price index and we've got the 10-year US Treasury yield. And we're just going to look at this, obviously, to see sort of what has happened with inflation. So if we think about inflation in general, there's a concept known as the Phillips curve. So the Phillips curve says that there is a short-term trade-off between inflation and economic activity. So basically, if the economy is doing well and there is low unemployment, that will lead to inflation. So that will, of course, lead to increases in wages and increases in goods. Now, this is what people used to, well, I think people still believe in it, but this is what people used to think was a relationship between economic activity and inflation, but it has not really happened for a while. So if we go back and we look at history, so in the 60s, there was really low unemployment and that pushed wage growth up. So people started getting paid more, which makes intuitive sense, right? That if the labor market's really tight, people are going to start getting paid more. So that happened in the 60s. In the 70s, of course, we had the oil shock that inflation spiked up into the early 80s, and there was a big recession. Obviously, you can see dramatically higher interest rates in the 80s, and that brought inflation down. Now, since then, this relationship has sort of gone away. Interest rates have continued to move lower. We've gone through periods of really strong economic growth and then weaker economic growth, but inflation stayed relatively low. And if we sort of look in this last decade, inflation was very low. So low to the point where the Federal Reserve in the US for the first time came out and actually said what their inflation target was, which they never said in the past, which they said was 2%. Now that's changed since then, but through this very long, sort of decade-long area of time of low inflation, but at the end of the day, inflation has been really, really low for a while. Now, why has this happened? Nobody, of course, knows, but there has been a lot of speculation, which I've thrown into three different buckets here: globalization, technology, and changes in the labor market. So why have we experienced such low inflation? Well, one theory is, of course, we've had the offshoring of jobs. So in the past, obviously, when there were tight labor markets, that led to wage growth. That hasn't happened because a lot of jobs, particularly around manufacturing and then some also service jobs, have been offshore to cheaper locations. So, of course, keeping wages down keeps the cost for any sort of business to produce goods and services down. And that has had an impact in inflation. This idea of just-in-time supply chains, right, where you have to forecast demand very accurately, but you're not sitting on there. You're not, as a company, you don't sit there with a lot of inventory, right? So, if you were a car company, you were getting the parts delivered the day before you actually put them into a car, instead of having this giant warehouse that periodically gets filled up and then you empty when you're manufacturing the cars. That's another, that of course takes cost out of the supply chain, which can keep a lid on inflation. So technology. So number one, productivity gains from technology. So we're all using a lot more technology. So everything from just the fact that we're sitting there using computers every day at work to the fact that we now have factories where a lot of it's automated and there's robots doing things. All of these different technology gains also keep a lid on, once again, wage growth. because you can just replace humans with machines at a certain point. We've got very asset-light companies so that you don't have to order. So we talk about this a lot. Technology companies are very scalable. They don't have to build a factory to every time there's a demand increase. So all of that, of course, takes cost out. We have greater price transparency because of the internet. So now, of course, I can go on and check prices on goods basically all around the world and have them shipped to me. This price discovery makes it harder for companies to raise prices because anyone at any time can go out and figure out a cheaper way of doing things. So it's kept a lid on prices. Then we've had a lot of changes in the labor markets. Everyone loves this flexibility, this Uberization of work, where basically anytime you want to hop in your car, you can go make some money. Then if you're done, want to go to the beach, you just clock off and you're off to the beach. Well, maybe that's great from a flexibility standpoint, but it's also dampened wages. So if we think about, Ubers versus kind of traditional taxis, where you have to pay someone all day, regardless of the demand, that has kept a cap on wages. Unions sort of across the world, particularly in some countries, there's been a decline in the power of unions. So their inability to collectively bargain for higher wages has put more power in employers' hands than employees. That's the whole reason a union was started, right? To sort of switch up that balance of power. Well, it's flipped back. And then really, in a lot of countries around the world, minimum wage increases have gone slower than the inflation we have had. So from a real perspective, a real wage perspective, we have seen a drop in wages. So all of these factors, some of these factors, a combination, have dampened inflation. But recently, we have seen signs that this may no longer be true. So we've seen some jumps in, and I've got obviously the US and Australia here. So particularly in the US, we've seen some pretty big jumps, close to 6% in inflation. So these are annualized readings, but we're taking them monthly. Same thing in Australia. We just saw a big jump in New Zealand, I think last week. So we're starting to see signs that maybe inflation, after being dormant for a very long time, is starting to come back. So I'm going to use some of the stuff that Peter Warren's talked about in his Your Money Weekly on Friday. Kind of fallen into two camps. So there's no denying that inflation has picked up, but there are these two camps. There's one that say, okay, this is the start of inflation. And then there's this other camp that says this is transitory, as in it will go away. So let's go through the arguments of these two camps. And once again, I don't have a dog in the fight. But I'm just relaying the arguments. You can make up your own mind. Then we'll talk about some of the investment implications. All right. So there's sort of four reasons that people have been saying that inflation may be here to stay. So number one, that the expectations of inflation are increasing. So much like a lot of things in life, if the expectations of inflation are increasing, then all of a sudden that can actually cause more inflation. So if your expectation is you're going to pay more in the future, you might go try to buy stuff right now. And that, of course, can push up prices. Your expectation that inflation is increasing, you might go to your boss and say, I want a raise. I need a raise to help pay for what's happening with inflation. And all of that can kind of trickle through and contribute to inflation. The next thing is there is actual wage growth. So we are seeing fairly strong wage growth right now for the first time, kind of in a long time. And that wage growth, of course, particularly when we've switched to an economy that is more capital light, wages are, of course, important, and that can trickle through and lead to higher prices. Commodity prices are going up pretty quickly. So we saw a huge dip in commodity prices when we were in the GFC. Like, I think the best example, not the GFC, sorry, the COVID related, whatever we want to call it, that's still going on, disruption. We saw a big drop in commodity prices. Oil is sort of a poster child for this. So if you remember back, oil futures actually went negative at one point. But we've seen a huge increase in oil, coal, iron ore, although that's come back a little bit and then gone back up. We've seen all of these rising commodity prices. Much like we learned back in the 70s with the oil shock, that commodity prices as inputs into producing goods and services can lead to inflation as well. And then finally, we've seen all these supply chain disruptions. So basically, this just-in-time that I was talking about, sort of just-in-time supply chain, has fallen apart. There are huge blockages at ports. Countries are unable to get things in. There are shortages, fuel shortages, food shortages going on, depending upon which country you're in. There's all sorts of supply chain disruptions, which are pushing up prices as well. So that's the inflation will continue to grow argument. Then, if I can advance a slide. All right, then there's this inflation is transitory argument. And this argument, by the way, the interesting thing about this is this argument is actually somewhat dividing central banks, which we'll get to in a second. So I think, central banks are trying to figure out what's going on. We'll say the main central banks, including Australia, still are in this transitory camp, but our friends over in New Zealand have a different opinion, the New Zealand Central Bank. But anyway, let's talk about this inflation is transitory. So basically this argument is that as countries are emerging from COVID and COVID-related lockdowns, that there are temporary issues that are happening. Those temporary issues will go away. And two of the big arguments around this is that, number one, when we talk about wage growth, and a lot of this wage growth is saying that labor markets are very tight. That is, of course, giving advantage to employees, whether they want to go out and find another job or negotiate higher wages. A lot of people are saying this is a little bit of a farce. So particularly like if you sit there and you look in the US, even though the unemployment rate is very low and the wages have gone up 4.6% year on year, unemployment rate's down to 4.8%. The argument is that this is not looking at the full specter of people that participate in the labor force. So basically what it's saying is all of the government-related fiscal stimulus that happened around COVID has caused a lot of people that will need to work to not look for a job. And of course, the way that they measure the unemployment rate is you have to be looking for a job, actively looking for a job to be considered someone who's seeking employment. And what they're saying is that as they unwind a lot of this fiscal stimulus, that people will start going back into the labor force. So they're saying 6 million people are not in the labor force, but they do want a job. That's 1 million more before the pandemic. So because they're not in the survey, they're not counted in any of these measures. So that's one thing. The other notion is that the consumer, so a lot of this obviously is increased consumer spending. The consumer is actually more tapped out than it appears. And one thing I was going to say about labor is like, if we look at Australia, obviously we have no migration right now. So whether that's skilled migration, whether that's backpackers coming to spend a couple years working in the service industry, there's no migration right now. So that, of course, is another example of how sort of this COVID hangover is increasing wages, lowering unemployment. The other reason, or a couple of the other reasons that this transitory camp is saying that inflation will go away is they're saying basically, the consumers are actually more tapped out than they appear. And that this sort of surge of spending that has emerged as people are coming out of COVID will soon go away. Two reasons they're pointing to, or the big reason that they're pointing to, is debt. So if you look at the US government debt, household debt, business debt, it's close to 300 trillion. And that's double what the previous peak was, which was in the GFC. So that is, that's pretty shocking. The debt to GDP ratio in the US is 350%, and kind of the previous high was 280%. And this isn't just a US problem. So global debt has jumped by $40 trillion during sort of the pandemic response. We've seen the same thing in Australia. Obviously, government debt has gone up a lot. Household debt is up. So sort of this notion that, people are saving more money. So in COVID, people were saving more money, but this is quickly, as you see in the US, dropping off. And that the notion that consumers will continue to spend the way they are spending right now is, in their opinion, not something that's going to happen. So we've seen right here, so consumer durable goods. So a consumer durable good is, basically something that is something that lasts a while that you buy. So whether that is appliances around your house or jewelry or cars, lots of things that are going to last for a while. So there's been this huge surge, but the expectation is this is sort of just this post-COVID surge, which will soon back off. So the idea here is that inflation is actually transitory and will go down. So once again, I don't have a dog in this fight, but these are kind of the arguments. So we're going to talk about what the implications are if inflation starts to take off. And one thing, there's an article in the AFR today that was talking about the enormous, and they listed all these categories, which were pretty funny. There's hairdressing was one of them, but just in Sydney, as Sydney came out of a lockdown, that there was this huge surge of spending. That the expectation is obviously the same thing's going to happen in the ACT. The same thing is going to happen in Victoria as those states and territories emerge from lockdown as well. And yeah, personally, I'd say I spent a lot of money this weekend. All right, let's talk about returns. So I'm going to use a couple different charts that were in this really interesting First Links article that was published. And first, we're going to look at nominal total return. So this is all looking from an Australian perspective. So nominal total returns, at this point, we'll just look at Aussie shares. We'll move on to some other asset classes. But Australian shares during inflationary cycles. So basically, there are four different rising inflation cycles. So you guys can read, but 1900s and 1920, 34 to 52, 63 to 75, and then 98 to 2008. And in each one of these are looking at just the average Australian share return during these periods. You can see that they're lower, right, versus these other periods. And we'll talk about sort of why in a second. So, the thing that sort of jumps out at you on this page is that they're not that low, but they are certainly lower than these falling inflation environments. But as people have probably picked up, as investors, we can't look at nominal returns. So nominal returns do us no good. So a nominal return is just the return of the assets. It does not take inflation into account. But why do we invest? Well, we save and we invest because we want to spend money in the future. Simple example is retirement. So what are you doing by putting money into your super fund? Well, you are simply going to spend it later. So instead of going out and spending your money now, you'll save it. You'll hopefully earn a return. You'll invest it. You'll hopefully earn a return. Then you'll spend the money later. So nominal doesn't do us any good because nominal doesn't take inflation into account. We need to see what the purchasing power of our money is. So if we look at the real returns, so real returns take inflation into account. Now, one thing is important to note, nominal returns is what most of the investment industry tells you. So anytime you sit there and you look at how did an ETF do or a fund do or anything else, anytime we look at these long-term returns and everyone comes out and says the stock market returns 10% a year, that's not actually true, right? If we look at real returns. So these are real returns. Now, when we start looking at these same periods, they are very, very low. So if we're talking 1.8%, 2.4%, most people do not have returns that low baked into their expectations for the future. So we always talk about this, and we'll talk about it on Thursday again. We talk about the required rate of return that's needed to achieve a goal. There are very few people who have expectations that, over a 12-year period, the market's going to return 1.8% in real returns. So just remember that we have had significantly lower returns and these are looking at shares. We'll talk about other asset classes in a second. We've had significantly lower real returns during inflationary periods. I'll just pause. Okay, I will get to those questions. All right, so let's talk about some of the considerations for investing in an inflationary environment. All right, So one thing, and we have a question that's somewhat related to this, we'll get to. So inflation is often accompanied by increases in interest rates. We'll sort of talk about how inflation impacts companies, but another thing that benefits almost every single investment is falling interest rates. So we talked about this before, how interest rates influence share prices by basically making future cash flows worth more, which increases the valuation levels on shares. Falling in interest rates mathematically increases bond returns that you get. Opposite is true when interest rates go up. So just remember that inflation does not happen by itself. If we go back and we look at this first chart, what are we looking at here, right? We are looking at, this is inflation. This other line, I'm colorblind, so I'm not good at this stuff, but this other line, the one that is up there, whatever color that's a 10-year US Treasury rate. So you can see that they are moving in lockstep. So as inflation goes up, what happens to combat that? Central banks raise interest rates. Just remember, this does not happen in isolation. All right. So at a high level, and we'll get into some specifics around this, inflation has historically been negative for all asset classes. So shares generally perform better than things like bonds during an inflationary environment, which we'll spend some time talking about right now, or a little lower on the page. But it's been negative for all asset classes. So all asset classes have had lower returns in inflationary environments. But there are certain sectors and investment styles that are not impacted as much. And we'll talk about those towards the bottom of the page. So just something to keep in mind. If we are moving into an inflationary environment, well, from a relative sense, maybe there are certain sectors that could do better. In general, investments have not performed as well, all investments. And really the notion and the problem that you have with inflation, so investments with fixed rates of return, we'll talk about what this means in a second, will generally perform very poorly compared to investments with floating rates of return. Okay, so let's talk about what a fixed rate of return. The most obvious fixed rate of return is a bond, right? So I am buying a fixed rate bond, and in exchange for lending somebody money, they will pay me a set amount of interest payments over a set amount of time, then they'll give me my money back. So that, of course, performs poorly in an inflationary environment because when they start paying me those interest payments and when they give me my money back, it will all be worth less because inflation has gone up, right? So the purchasing power of my dollars is going down, right? So that's not a good thing. So two things will generally happen. One, my real return will go down, right? My real return could potentially go negative. Right. So if we start looking at, and I'm not saying this stuff will continue, but if we start looking at close to 6% year on year monthly increases in inflation, in that environment, almost every fixed income asset that anyone's bought in the last 10 years would be negative, right? Because interest rates are so low. The real return would be negative if they kept that up. The other thing, of course, is bond prices will react to inflationary environments and they'll react to rising interest rates. So forget your real return. Your return will probably just be negative because those bond prices will come down. Floating rates of return, we'll talk about more than bonds in a second. Floating rates of return is there are floating rate bonds. So there are bonds, of course, that will reset based on how interest rates change. They are not as popular because they're not as popular, frankly, for people to issue. So they're not as popular. There are bonds, of course, that are linked to CPI, so the Consumer Price Index. So TIPS, so Treasury Inflation Protectionary Securities in the US, for example. So there are securities that are also linked to that. But fixed and floating also applies to companies. So right when we're shareholders, we are buying companies. We need to think about what kind of company we're buying. And we need to think about the future cash flows that company is going to generate. So let's use a very simplistic example that if I go out there, if I'm a company and I go out there and sign a contract with somebody and I say, okay, you want to buy a bunch of my, goods, consulting services. If you want to buy a bunch of my consulting services, let's sign a contract for the next 5 years and I'll send a consultant out to your office every day for the next 5 years. And I sign a contract, and that contract is based on a certain rate that will be paid for the next 5 years. That, in a way, even though I'm a company, right, that is a fixed rate of return for at least that portion of my earnings. Whereas there are companies that are on floating rates of return, where basically I have the ability, it's either a one-off transaction, like if I always use this example, if I make Coke and I'm Coca-Cola, well, it's a one-off transaction. I'll go buy a Coke today, but I can raise prices tomorrow. Maybe tomorrow, if inflation goes up, I can show up and the prices are higher. Whereas if I have a fixed rate contract, I can't do that. So something to think about. So fixed and floating does not just apply to bonds. It can also apply to the types of businesses that you're in. So what are some businesses that traditionally have done decently in an inflationary environment? So go through a couple. Infrastructure. So what is infrastructure? So infrastructure is basically a good or service that people use every day, that generally has high upfront costs, and is needed by everybody. So infrastructure could be everything from a road, like a toll road, to an airport, although we seemingly need airports less and less right now. So toll road, airport, like oil pipeline, electricity grid. So infrastructure companies generally perform pretty well. And the reason they generally perform pretty well is because they have automatic inflation protection built into their contracts. So if you think about how this works, and listed property is similar. So let me talk about listed property, and we'll put them both together. Listed property generally performs pretty well because they also have inflation built into their contract. So, whatever Morningstar pays to rent this office, I would suspect, and I know we're on a 10-year contract, so it's a long-term contract, but I know there's inflation built into that, right? Because they are trying to protect themselves. These companies are trying to protect themselves, whoever owns this building, from any inflation during one of these long contracts. And infrastructure and listed property, there are some similarities between the two of them. There's a couple other reasons why they perform well in inflationary environments. So both of them require large upfront costs, right? To build Barangaroo probably costs a lot. So there are large upfront costs. Same thing to build a new airport, to build a new road. They all cost a lot. So generally, what these companies do is they take on a lot of debt. They take on debt to build the building, build the road. And then what they do is over time, they, of course, lock in these contracts where they're sort of locking in a rate of return. So if you think about sort of infrastructure, if we think about Transurban, for example, that the state of New South Wales wants to build a new road, doesn't really want to pay for it. So they go to Transurban, they say, hey, listen, you build the road, we'll give you a toll concession. And Transurban would go back to them and say, okay, well, we want to be able to raise tolls over this period, however long this concessionary period is. And we want to be able to have a set schedule of raising tolls, and we want inflation on top of that. Because we have to go out and borrow a bunch of money and build this road, and we don't want to do that and all of a sudden earn returns that are below our cost of capital. So generally, that's sort of the bargain with infrastructure companies, and it's kind of like the implicit bargain with property. Whether you're going to build a building, a mall, an apartment building, anything else, generally people protect themselves, companies protect themselves. The other reason infrastructure and listed property work well in inflationary environments is because they take on a lot of debt. And if you have a lot of debt, inflation is your friend, right? So just like if I have a lot of money in my bank account, that inflation is bad because that will erode the purchasing power of my dollar. The opposite happens if I'm in a lot of debt. So all of a sudden, my debt, as long as it's fixed rate, my debt becomes in real terms worth less. So that helps. And the other thing that really helps is the fact that it becomes a lot more expensive to build another building, right? So at the end of the day, if you are, and there's some weird things going on with listed property right now, just because of people are trying to figure out what the impact is going to be of COVID. But if there's a shortage of office space in the Sydney CBD, for example, well, all of a sudden it's going to be a lot more expensive to build a new building because labor is going to be higher. All of the goods that are used, so commodities are going to go up in price. So it's going to be more expensive for me to build my building. So what does that do? Well, it makes somebody else's building worth more. If it's more expensive to build something new than the people that already have buildings. Those assets go up in value. So that's why kind of traditionally infrastructure and listed property have done pretty well. Housing's done pretty decently in inflationary environments, although be careful about interest rates, right? So interest rates, if interest rates exceed the growth of wages, then all of a sudden that's a little bit of a problem for you. But yeah, generally housing is done pretty well. And then shares of companies that have pricing power. So if we think about a company and why in general it's better to own shares than bonds in an inflationary environment, is because companies that are able to pass on price increases that either match or exceed potentially the input cost increase will do fine, right? So if it costs me 5% more to build a car, I can sell cars for 5% more, I'm okay, right? It's a little bit of a wash for me as a company. The problem, of course, you run into is as car prices go up, maybe people just decide not to buy cars. That's why we're looking at that. That's why when we went back here, we were looking at consumer durable goods, right? Like a car, because as they go up in price, people can decide just not to buy them. I don't need a new car this year. I'll wait till next year. You know, 1 billion people do that around the world. It has a pretty big impact. Consumer defensive segment. So we talked about consumer durables. So for consumer durables, oftentimes people do have the ability to delay the purchase of those. But if we look at consumer defensive, that is everyday items. So my Coke example, or just anything you go buy in Kohl's and Woolies, you know, stuff that you need to live your everyday life and you can't really do without. So consumer defensive have generally done pretty well because they've been able to pass on those price increases because there really aren't that many substitutes that people can go to. And then commodities. So commodities, a real asset like commodities, they've generally performed pretty well in inflationary environments. And a lot of it, like, you know, if we go back and we look at the 70s and we look at oil, well, you know, part of that is because it was the giant price spike in oil that led to inflation. So you do tend to see commodities do pretty decently. Thank you guys for joining. I appreciate it. Clearly a topic that resonated, which is good. So yeah, thanks. Hope everyone has a good day.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.